There's a huge misconception among the vast majority of investors. Most people think that if we invest money in property, we invest money in stocks, that over the long term prices go up, we make money, we make purchasing power. But actually things are going up because the US dollar is devaluing. That's why the same bar of gold used to be just a few $100s and now it's several $1,000s. So the same bar of gold, it's the same thing, suddenly becomes more expensive. That's just because the US dollar is cheaper. Now, once we look at this ratio, once we look at how much is the US dollar actually devaluing, we try to figure out how much returns do we actually get from those different investments. Say we didn't have any devaluation of the dollar, then we find something very interesting. Effectively, what we're doing when we buy the S&P 500 is just evading the inflation tax. So we don't make any money. The only place where we made money long term, that was unfortunately the tech stocks. So in a way, we are forced to take risk. This is the Nasdaq 100 in US dollars. The vertical line here, that's when Bitcoin got created. And this is the story why people buy stocks. This is the same on a logarithmic scale. This here is the dot-com bubble crash. This here is the global financial crisis. Now this, per contrast, is the Nasdaq 100 relative to the monetary debasement. We still gain purchasing power. So buying tech stocks long term was very, very profitable. It was the right thing to do. But compare this with the S&P 500 relative to the US money supply. This is a very long-term chart. It starts in 1959. And we have very long periods where we don't gain any purchasing power if we had a constant monetary base. This here is 37 years of data. What kind of a drop in purchasing power was this? It was minus 74%. The dotted line, that's the long-term ratio of the S&P 500 relative to the money supply. Now have a look at this. At the bottom here, that's the maximum drawdown from the all-time high to that current price. And it seems like the oil crisis in the 1970s and the dot-com crash plus global financial crisis brought us to the same kind of relative depression, a purchasing power loss of a bit over 70%. So really, just based on this chart, there is a good case to be made that the stock market might fall by roughly 50% from here to the long-term equilibrium. This is also what the long-term price to earnings ratio implies. It's currently at 37. If that was to fall by 50%, we'd be at around 19, and we tended to hover around the 20 mark. So a PE ratio of 20 means that when we buy a stock, we need 20 years to make our money back. Currently, it's not 20 years. Currently, it's 37 years. This here was .com. This here was the bubble before the Great Depression in the 1930s. So buying the S&P 500 doesn't bring us long-term purchasing power. It just brings us an escape path from all of this monetary debasement. But again, tech stocks were a viable solution over the last 40 years. The Nasdaq 100 relative to the money supply. Here is the Nasdaq 100 relative to the S&P 500. So tech becomes a more and more important part of the US economy. Currently, we are at a very similar ratio to the top of .com, where we see another crash. That's of course very hard to say. That depends on whether or not the promises of artificial intelligence will turn into real profit. And so for this video, I want to look at the different Nasdaq 100 constituents, especially the larger ones, the top 10. Isn't it interesting that Walmart is part of a technology company? It's in the Nasdaq 100. We're going to look at Walmart as well, but let's start off with Nvidia. And as you might know, I always like to look at the ratios. Does it make sense to buy an individual asset over just the benchmark? So in crypto, that is, does it make sense to buy a particular altcoin over Bitcoin? Now here in this case, we're looking at, does it make sense to buy a particular tech stocks compared to just say buying QQQ, right? So a Nasdaq 100 ETF. Let's start off with Nvidia. Here we've got Nvidia relative to the Nasdaq 100. The chart starts in 1999. We have seen quite nice outperformance. This year was driven by the crypto hype when people bought a GPU to mine Ethereum. And of course, the recent run is artificial intelligence. We have not seen any outperformance over the last 6 to 7 months. We can make the argument that the outperformance was very meager over the last 2 years even. So that's 7% or so. What I also find interesting is how volatile is that outperformance? So again, let's have a look at the maximum drawdown from the all-time high of Nvidia relative to technology stocks, to the Nasdaq 100, and that bottomed at around 77%, in the peak even at 84%. So Nvidia underperformed the rest of tech in the year 2022 and 2023 by more than 80%. And it appears as if that volatility is now shrinking. But still, this was not a smooth ride at all. Is the additional risk of Nvidia still worth it, given that there was so little outperformance? I'm not so sure. We might as well just buy the Nasdaq 100 at that point. Now, what about Apple? Apple is almost as big as Nvidia. Here's the long-term Apple chart relative to the Nasdaq 100. The long-term drawdown was even worse to what we have experienced with Nvidia, right? An underperformance of 96%. That was when Steve Jobs was not involved in Apple. Then Steve Jobs came back. The rest is history. But still, the maximum drawdown since then was minus 44%. We are somewhere in the typical range now. We are not at the all-time high. We are 20% below the all-time high. We have not seen any outperformance of Apple over the rest of the Nasdaq 100 over the last 6 years. Roughly. We're going to discuss all of the top 10 to try to figure out which one is worth investing right now. Where do we still have positive momentum? So let's continue with Microsoft, where we've got a very long history as well. This is Microsoft relative to the Nasdaq 100. No outperformance for the last 30 years even. Isn't that impressive? Have a look at the maximum drawdown. It's not as dramatic as Nvidia or Apple. Microsoft is a more conservative tech firm. Still, it did lose quite a bit during the dot-com crash, then subsequently because it didn't catch the mobile wave properly. The recovery came with cloud computing, and now the market is doubting Microsoft's AI investments. And so it's doing very poorly again relative to the rest of the market. Those trends tend to be rather constant. Nobody wants to buy Microsoft right now. And I'm not sure if I should support Microsoft here, because I do not like Copilot, and I also think that Azure, so the cloud platform, has quite a bit of competition by AWS and by Google Cloud. So that's a no for Microsoft from me as well. What about Amazon? Here is Amazon relative to the Nasdaq 100. No outperformance for the last 10 years, roughly. Since Jeff Bezos has left the company, Amazon did not perform as well as the rest of the market, and it's close to its worst point ever relative to the rest of the tech world. What about Google? Here is Google, and Google looks nicer. Google does have long-term outperformance. It did have quite a bit of a rally, and also the volatility for a tech stock relative to the rest of the Nasdaq isn't too high. It's even more conservative than Microsoft, as in we turned around at minus 36% or so from the all-time high relative to the Nasdaq 100. Comparatively little volatility, but somewhat constant outperformance. Now, is the current price justified? Who knows? But it seems like Google is always able to catch up. They've been able to beat ChatGPT in many ways with Gemini. I personally also like their cloud platform more than Azure's and more than Amazon's. And then there's of course also YouTube, where you're watching this video, and there's no meaningful competition for YouTube. So I think Google is a nice long-term buy over just a Nasdaq 100 ETF. Now here's a stock not many retail investors talk about, but I think that's a blind spot. Have a look at Broadcom's price relative to the Nasdaq 100. It has been outperforming very consistently over the last 17 years, more than 1,000% extra performance on top of the Nasdaq 100. And the volatility, so the maximum drawdown from the all-time high to the bottom, is comparable to Google's. And so just based on that data, without even looking at any fundamentals, I think it does make sense to get into Broadcom. What about Tesla? Tesla is incredibly risky. This is Tesla relative to the Nasdaq 100. It did draw down by more than 60% recently, even close to 70% from the all-time high. And the outperformance is rather lackluster. This year was the scaling of Model S. This year was the scaling of Model 3. And since then, Tesla is struggling, and they're selling the dream of humanoid robots. But we haven't yet seen the commercial viability of humanoid robots. And so I think Tesla has more way to go down. And for full disclosure, I do have a Tesla short open in my brokerage account. I am betting on falling prices of Tesla because I have a very hard time believing that humanoid robots will be quick enough to scale to push this big company around again. In the EV market, Tesla has too much competition. The brand is facing its difficulties as well. And so for the next months, I don't see Tesla outperforming the Nasdaq 100. What about Meta or Facebook? That's over here. Also incredibly risky. This was the sell-off after the big push towards the metaverse and virtual reality, which unfortunately did not turn into profit. Then Mark Zuckerberg decided to reduce the investments, which Wall Street liked very much. But it seems like Meta has a hard time becoming a leader in artificial intelligence. And so it starts to again underperform the Nasdaq 100 for the last 6 months. And very long term, we haven't even seen that much outperformance for the last 10 years, roughly. So much more volatility in Facebook with no additional gains, with negative momentum recently. So I'm not sure if it makes sense to own Meta over just QQQ, or simply owning the Nasdaq 100. And let's have a look at Walmart. And here is Walmart relative to the Nasdaq 100. No outperformance over the last 40 years. Here is the relative performance as a drawdown chart. And of course, there's all the political uncertainty with Walmart, right? The markets tend to rather become less globalized than more globalized. Walmart made a lot of money by importing goods from China. Now we've got the tariffs. And is Walmart really a tech stock? I've got my doubts as well. So really, among the top 10 tech stocks, I think Google and Broadcom are the best options. Tesla is a potential short. And then of course there's always QQQ, to simply buy the entire Nasdaq 100 as a benchmark investment that tended to, at least over the last 40 years, outperform monetary debasement, which cannot be said for the S&P 500. If you got some value out of this video, feel free to give it a like. It will help the channel grow. Feel free to also send it to your friends in case they might be interested in it as well. There's also the subscribe button in case you're not yet following the channel. I publish videos regularly over here. See you next time on YouTube, or see you potentially also in the premium membership. Link to premium is over here. That's where I share my own trades. Thanks for watching. See you next time. Cheers.